And we begin with economic affairs. Structural and governance reforms in struggling state-owned enterprises, stepping up the fight against corruption in public service, maintaining a monetary policy stance which supports growth, and enhancing the anti-money laundering measures are just some of the conditions that Kenya has to abide by if it is to fully tap into the new 252 billion shillings loan from the International Monetary Fund. The fund's board approved the loan on Friday night, which it says is fundamentally aimed at strengthening Kenya's economic vulnerabilities and the response to COVID-19. Our business editor, no less, Julian Zamboko, has those details.
The International Monetary Fund has come to Kenya's rescue yet again. After the 80 billion shillings loan approved in May 2020 in the wake of the COVID-19 pandemic, the fund has now approved an even larger credit facility for Kenya, a 252 billion shillings 3-year loan. The funds will be disbursed as follows. 33.2 billion shillings is due for immediate disbursement. 78 billion shillings will be due for release before the end of the current financial year on June 30th, 2021. The remaining 140 billion shillings will be released based on how well Kenya implements the conditions attached to the new loan facility.
Very early next week sometime, there will be the consequential disbursements. We'll receive the disbursements of about $314 million over the next few days after that.
That 48% of the funds are being disbursed within the current financial year could be a signal that the fund may have heeded the request from the National Treasury for speedy disbursement of funds in view of the challenges precipitated by the COVID-19 pandemic. Earlier this week, Treasury CS Okuritani tabled a raft of requests to the IMF, including the need for greater flexibility in the conditions attached to its program support. One of the main conditions of the loan approved under the Extended Credit Facility and the Extended Fund Facility is that the government will commit to streamlining struggling state-owned enterprises which periodically rely on taxpayer-funded bailouts to remain afloat. Worth noting is that the latest approval by the IMF comes just days after President Uhuru Kenyatta appointed a task force to comprehensively review the power purchase agreements entered between Kenya Power and its energy suppliers. The IMF has also placed policy formulation by the Central Bank of Kenya on its radar as one of the conditions attached to the new loan facility. The fund wants Kenya's apex bank to maintain an accommodative monetary policy stance in the context of the inflation targeting regime. This essentially means that the fund does not anticipate to see the Central Bank of Kenya hike the benchmark rate, which has been retained at 7.5%. The IMF also wants Kenya to observe a free-floating exchange rate of the shilling. This is important given that 3 years ago the fund questioned the exchange rate of the shilling, arguing it had been overvalued by as much as 17%. In May 2020, while extending the 80 billion shillings loan to Kenya in the wake of the COVID-19 pandemic, the IMF downgraded Kenya's vulnerability to debt distress, citing growing concerns over the country's debt position. The fund now says that the conditions attached to the new loan should help Kenya to address its debt vulnerabilities. Julian Zamboko, NTV.